the way this will work is I'm just going to kick it over to you, Patrick. And then, Victor, Nico, and then yourself can each give self-introductions so that people know who you are and why you're on a panel about the state of AI in investment management. And then, and then have at it. The goal is to help people understand what's happening with AI and machine learning in this domain. And I think the three of you are amazing people to do that. So without any further ado, Patrick, our moderator, take it away and have fun, guys. I'll be here if anything is required.
Okay,
Cool,
thank you. Well, good afternoon to you all. So we're here for this webinar on the state of AI in investment management. I'm Patrick Dugnolle. I am the US head of multi-asset and quantitative solution at BNP Paribas Asset Management. I've been working in doing computer quant models and factor investing for 16 years with BNP Paribas. And I'm a big fan of AI, though I have a view of AI which is kind of old-fashioned, because I was trained with AI some 25 years ago, or maybe even earlier. And so, but before going into that, I'll invite Victor to introduce himself. Victor?
Thank you. Hi. Thanks for inviting us to this panel. Sounds like will be an interesting conversation. So I work for State Street as a data scientist. I have been in the analytical world for quite some time. I originally have a PhD in theoretical physics, but since then I have moved into finance, mostly in the quantitative world, and over the last 3 years, specifically focus on artificial intelligence. So the transition from finance quantitative field to artificial intelligence is not really a big transition. We have been working with these models for a long time. And now the interesting part about AI these days, especially in finance, is the handle of big data. And in some ways, that's a very exciting opportunity now. And then the things that it could bring would be very transformative. So let's hope we can talk about some of that today.
Nico, would you like to introduce yourself?
Thanks, Patrick. My name is Nico Smuts. I'm an investment data scientist at 91. So we are formerly known as Investec Asset Management, and we're a fund manager based in London, running global mutual fund portfolios. So my role as an investment data scientist, what that means is I sit on the desk with the fund managers using data science to generate alpha, improve the investment process, or just add value wherever we may find it. And I think it's incredibly interesting how many areas in fund management there are where you can apply data science and AI. So I was the first data scientist hired by Investec, so I'm having a lot of fun building out that function and finding new applications for this toolkit. My background is in hedge funds. I worked in equity research in a hedge fund, but also I have academic background in computer science and in finance. So I try and bring together all of these to try and make sense of the markets.
Wow, that's impressive. As an introduction about AI, I'd like to tell you a little story about AI before computer even existed. I mean, it's a story which happened in 1904, when the New York Times published an article about Clever Hans. Clever Hans was an intelligent horse who had been going around Europe for many years. Horses are known to be extremely intelligent, but Clever Hans was different. He displayed a human intelligence. Hans knew colors, numbers, advanced arithmetic. He could remember and spell the name of persons. He had no limit. However, it was all biased. He had learned the quickest way to receive his favorite reward, in order to find the correct answer, he could read minimal changes in the eyes of his questionnaire. So what does it tell us? What does this animal intelligence tell us about artificial intelligence? Like Hans, AI carefully reads all minimal variations in the input data. And when human intelligence is mimicked better and better, everyone gets mesmerized. However, there is no guarantee where the intelligence is coming from. The only sure thing is that results are highly dependent on input data and reward functions. Just like clever Hans, there is nothing magic about AI. So with that said, I'll ask the first topic of this webinar. And I'll ask you, Victor and Nico, what you think about the challenge of data clouds to integrate financial data into AI models. Is the financial industry effectively using big data and AI? Maybe, Victor, you want to start with that?
Yes. Okay, to address that particular question, I think we can take it in two different angles. And the part that AI has allowed us to kind of differentiate in data is between the structured data and unstructured data. So in terms of structured data, I don't think the finance industry has changed too much how they actually use data, especially in the financial data set, which is market data. So I think we're still using the same sort of systems, and I think we are in some ways stuck to that kind of framework that we had in the past. Now, in terms of unstructured data, I think that's where AI has given us a huge kind of different overlook at how data can be incorporated into the different operations of finance. So on that angle, AI has provided a big leap in terms of extracting information from different sources and being able to apply it to financial models for different reasons. Now, the effect on that, for example, into trading models or other types of things like that has been limited. But in operations and in other aspects of finance, that unstructured processing of data has given us big advances in many different aspects of finance. Also, there's a big use of AI and big data in issues like portfolio management, not necessarily in alpha generating, but in optimization of how to construct portfolios or how to do effective trading algorithms. So I would think that that's how I will describe it.
Well, Nico, would you like to add something? And maybe.
Yeah, I think on the topic of big data, I was listening briefly to the banking panel, and I think banks are generally ahead of fund managers on this because they've been dealing with unstructured data for much longer, and the banks have to understand millions of customers, and there isn't a lot of structured data available. Whereas in fund management, we've been kind of spoiled in the sense that we only need to cover thousands or tens of thousands of companies and securities, and there is so much structured data out there that's kind of what we tend to go for. But I think, especially in the current market conditions where more and more of the insights come from unstructured data, that pushes fund managers more towards the AI route, where you need to deal with larger data sets and thus need more sophisticated algorithms, high performance computing clusters, cloud-based solutions. So I think that we're playing catch up with other parts of the financial industry, but definitely the momentum is picking up speed.
Do you think, Nico, that is why AI has been used more effectively in risk management, perhaps, or operations than in alpha generation?
Yeah, that's a really good question. I think as data scientists and people working on AI, we're all looking for the holy grail, which is that algorithm or that formula that will give you an edge and allow you to see around the corner to predict what's coming next. But I think there's a trade-off, right? Because this approach of investing a lot of time in alpha generation using more complex algorithms is difficult, and the risk is that you can get it right, but you can also get it wrong. And even if you do get it right, those signals tend to decay over time. And so if you take into account the sustainability of the edge you create, often the numbers come out in favor of incremental gains in other areas. So as an example, trying to predict time series is extremely difficult. And that's essentially what a lot of the predictive algorithms try to do in financial markets. It's heterogeneous, it's path dependent. It's just a very difficult problem to solve. And if you look at something like optimizing trading or finding liquidity or quantifying and automating some peripheral part of the investment process, often that operational gain, you can lock it in. It's not going to get decayed away as quickly, and the gains go straight to the bottom line. So as an example, if you find, and this is something we're doing, we're using machine learning to identify liquidity when we're trading in opaque markets. So if you can find an algorithm that can just save you 1 basis point in implementation shortfall per trade, and each trade has 2 legs, and let's say you turn over your portfolio twice, that's 4 basis points you've saved, which is kind of has a high probability of being repeatable. Whereas, using it for alpha generation, it's a bit less repeatable. It's a bit more chunky in terms of there are periods when it works, but then there are also periods when it doesn't work. So at 91, we try and spread across those 2 domains, work on alpha generation, but also lock in those incremental gains on the operational and implementation side.
Victor?
To that point about why AI has made major inroads in other areas than investments in specifically in finance. I think that there is also underlying issue, not just the complication of the problem at hand. It's a very challenging problem, I agree, but on the other hand is the nature of markets. For example, like I think people who probably implemented AI techniques to extract information from unstructured data, they have been doing it for a while, and then there were opportunities at that time where this was actually probably made a difference in alpha generating strategies. Nowadays, the markets have adapted to that, and then a lot of the people, all of these techniques and all of these procedures or methodologies are widely known and incorporated, and the data is widely available to many people. So I think the market has already taken some of that edge away. So I think the nature of markets being adaptive is part of the reason why this is so challenging, which brings us to the other part of why alpha generation is difficult. And then it's one of the things that AI hasn't been able to completely crack that aspect of it, is that the nature of markets being adaptive means that they are non-stationary by nature, and that non-stationarity is not so far compatible with a lot of the techniques in AI these days. For example, when you try to do image recognition, you're always relying on that your images are going to keep those patterns in time. And it's true, a face doesn't change that quickly. If you take 10,000 pictures of your face over the last 5 years, most likely your features are going to be pretty much the same. They're not going to change. With markets, doesn't happen that way. Every time you take a picture, the pixels on your face are going to be changing completely. So you have a different face every time you take a picture. So that's why it's so challenging to provide that type of AI techniques into these markets. There is some hope in that direction, and I think the inroads that they have been making in terms of reinforcement learning has some potential to address those problems in a realistic way. Now, the value of AI techniques is in handling large amount of data, which finance to a certain degree has been limited because we have done very well in terms of one asset pricing, for example. We do very well, but when we deal with multiple assets and the interaction of those multiple assets, the problem becomes a lot more complicated. So I think that from that perspective, I think AI has still a lot of potential because it's still opening different areas which could be applied to finance. On the other hand, the success in other fields are not easily translated into finance right now because of those issues. The adaptability of markets.
Well, I both agree and disagree with you, Victor, on the part of stationarity, and it's certainly very difficult to apply AI to alpha generation. However, whether the markets are really non-stationary is, I believe, still an open question. For instance, don't you think that if you look at the past 90 years and the rational investor, is a rational investor in 1930 really different from a rational investor today? I mean, investing, it's still a matter of investing in companies with a profitable business model, which is with a stock price that is not too high, with a low risk profile and a good momentum. And that hasn't changed so much, I would say, for the past 90 years. But apart from that, there is another aspect, I believe, which comes directly from AI and which makes alpha generation a lot more difficult for AI to be successful. Because AI, basically, it's it's a matter of correlation. I mean, AI is a tool, an excellent tool to identify correlations. So 25 years ago, up to 20 years ago, we were massively using linear correlations because basically that's what we could master well with our computing tools and computing power. Now we've come to work with highly nonlinear correlations, and that's also why it works very well with risk management, because risk management is often a lot dealing with correlations. Whereas alpha generation, it's a question of causality, and correlation and causality may have a lot to do together, but we've all been taught very well that they are different, and that's one of the big things that makes things so much harder for alpha generation. I mean, if you, you know, because we have so much data at our disposal, because we have this dangerous belief that because we can add more data, we will eventually come with more intelligence, and we will eventually uncover virgin intelligence. However, from a statistical standpoint, it's dangerous to add more data blindly, because there is a big risk that you are not adding information, but piling noise. And if you reduce your signal to noise ratio, you will find spurious correlation. And that is the hard limit of artificial intelligence, whether you use big data, whether you use neural networks or linear correlation. You need something more than just artificial intelligence to find causality. Don't you think so?
Well, I think you made a good point in the sense that they are related. I mean, for example, as you look at time series, right? You might have two time series which might be related at times, but might not be related at times, right? Or you have cyclical correlations. So in other words, correlations that change in time. I mean, we have specific cases of that, for example, with the last crisis in the credit markets, right? We constructed these entities which were based on the aggregate behavior of a pool of securities, right? And then the assumption was that these correlations or these relations were stationary in general, not just nonlinear, but also stationary, right? So that means that even if they are related in a non-linear way or complicated way, we were assuming that those relations will stay in place. Well, it turns out that the markets are more variant than that, and then those correlations do change in time. So the point of them having a mortgage-backed security based on certain market conditions turned out to be totally different from a different market conditions, because the relations of those entities change significantly over time. And I think that's the challenge, that we haven't been able to incorporate those models to model properly those changes in time of those. So it's a time variant issue. It's not necessarily a non-linearity issue in terms of the relations of those securities. So, but then there may be patterns like the way that, for example, we learn, or the way that a dog learns how to catch a ball in the air. I mean, the algorithm that goes into this dog's mind is to be able to catch or to learn patterns in time, right? And that's what we seem to be trained on. We actually do pick patterns in time, not patterns, static patterns right now, but we do pick how the ball moves in time, right? So as we see the ball moving, we know we can predict where the ball is going to go, because we are embedded in being able to predict patterns that are constrained by physical reality. And I think those same systems can be translated into AI to be able to figure out patterns that are changing in time, and figure out the changing patterns that emerge from complicated interaction of different assets. And that's what I think the future might lie, right? To realize that those correlations are changing in time, and figuring out that pattern in time is what's going to really make a big difference.
Nico, is there anything you want to add on that?
Yeah, it's interesting the point you made, Victor, that looking at snapshots in time and then trying to predict where things will be from there. I think that's an approach we also use quite often, where predicting the future is really difficult. But if you can use AI to really understand the structure of the market or an industry or some set of securities at some point in time, it's often easier to see which securities are out of line, which assets have moved in a way that's different to what you'd expect. And that often gives you those nudges. And we use a hybrid quant fundamental process. And often the AI is really good for finding those opportunities where it's worth looking, where something is different. And you can then think about whether this is something that's a step change, or whether we think there's mean reversion or opportunities. And that's much harder to do if you don't have the AI to look at, for instance, the example you used, Patrick, of the correlations between assets. When those correlations suddenly break down for some subset of the universe, sometimes that's a trading opportunity, or sometimes that's something that's really fundamentally changed. And AI is often, at the moment, it finds it difficult to distinguish between those two. And we find it quite useful for the fundamental fund managers to then apply their insight and to see whether it's mean reversion or something that's changed permanently.
Well, so do you believe that the COVID-19 crisis has affected the investment industry thinking around AI, data, and risk management? Yeah.
Sure, I'll take this first one. I think the one thing that's been very clear to me, and I work with a lot of fundamental and hybrid portfolio managers as well, is there's been a sort of a passing interest in alternative data across the industry, but a lot of people that were on the fence are now fully convinced that alternative data has a lot of value and should be incorporated in the investment process as part of the core process. So just because the COVID crisis has moved so quickly, so much faster than a lot of standard economic indicators and forward-looking data points even, people have turned to things like road traffic, shipping data, electricity usage, carbon emissions, and of course the medical data that everyone's looking at. Using all of those to get a picture of what's really going on. And I think when we were all waiting for that first industrial production print from China, everyone knew it was going to be bad. And there was a good week or two before it came out, and we could really assess the damage. There was just a flurry of activity of people turning to alternative data to try and triangulate where that number is going to come out. And I think that is going to lead to a permanent change in the industry, a much bigger appetite for alternative data.
Victor?
Yeah, I will certainly agree with that. I mean, there are some examples in which you can see alternative data coming into the financial data directly. For example, credit is one of those. You see some models in which they're applying to prediction of credit default or defaults in securities, or in likelihood of companies probably degrading their credit ratings. by just, for example, looking at prospectus or looking at certain descriptive information on the web about a particular company. And they have been able to infer to a certain degree, right, that they increase or decrease in the default probabilities for a particular entity or individuals for that matter too, right? So I think that those type of probabilities or the increase or decrease of probability of default certainly filters into pricing very directly, right? And so those are the kind of type of models that will definitely make have made an impact in certain degree to the movement of prices in certain ways. So I would agree that that's part of is definitely something that is moving and then is becoming more prevalent. So
there is one thing that is puzzling me in the current market condition, and it's a very practical example. We've seen many low volatility strategies that were not performing as expected in the big drop of the market recently. And that's kind of puzzling because, and that shows another example of non-stationarity and because you would expect clearly those low volatility strategies are meant to be protective and to be defensive in that kind of market. So when they fail, it's all the more troubling. Don't you think so?
Oh yeah. I mean, I guess goes back to this idea that to your point about changing correlation or non-time varying changes in correlation, and that's a big part of that. I don't know if Nico has a different perspective on that, but
yeah, I've been thinking about that, and something we've been following, and something we follow on an ongoing basis anyway, is a lot of these systematic strategies actually follow very simple algorithms, risk parity, CTA, trend and carry strategies, etc., where they have to buy and sell according to a formula. And if too many funds follow the same formula, they actually exacerbate volatility in the market. So the classic example is with risk parity funds. When equity vol goes up, they have to sell down equities and buy bonds. And the more the equity market falls, vol goes up, they sell more, and so that leads to a much deeper dip. And I think this has shown the weakness of just following a simple strategy, and especially if that strategy works and you have copycats, that leads to the point where we are now, where so many investors try to do the same thing, and it just puts additional stress on markets. So I think we need to see more diversity in quantitative strategies. And there's certainly a strong incentive to, if you're running a quantitative strategy or anything systematic, to bring additional inputs and not just have a simple formula, so that it's more diversified and it doesn't tend to do the same trades that the rest of the market is doing on a given day.
Would you have any other examples of useful or on the contrary, failure in the current market conditions of AI tools you'd like to mention or you think of? Victor, Nico?
Yeah, so I'll follow on from that example I mentioned of when COVID started in China, and we were looking for the first kind of indications of how much economic activity had slowed down on the Chinese mainland and the surrounding area. There was this lag where everyone was waiting for the data to come out, and one of the banks did some really good work by tracking the amount of messages, the number of messages sent by ships. So the ships send, they transmit bearing, GPS coordinates, etc., on a regular basis, multiple times per second. And this very large data set, multiple gigabytes or terabytes, was mined for correlation with industrial activity, and that proved to be quite useful. So they built a kind of a daily index of activity, which is much faster moving and proved to be really helpful. So I think, creative uses of data that will give you just not necessarily predicting the future, but nowcasting, giving a much better, clearer picture of what's happening at the moment, is proving really helpful. And an additional example is this COVID crisis is almost like the same story playing out in lots of different markets with slight differences. And yet you can't, it's too time consuming to build a different model for every market. So building simple automated models that just fits a model to every country based on the latest available data is a huge win. And there are a lot of these COVID dashboards that have gone up. And so we've also built some internally that just gives each team the data that's relevant to them, whether it's a fixed income team, an equity team, or a regional specialist. So their AI has been very good at, I think, not necessarily doing things better, but doing it faster and more scalable.
Victor, on your side, which aspect of applications or investment AI have advanced more over the last year, according to you? And data algorithm.
Okay, from the operational side, all the low-hanging fruits from the traditional kind of successful stories of AI, which is image recognition, NLP, that had been is a big movement or set of investments in applications to leverage on those tools to be able to help the operations of a bank. For example, like dealing with signature recognition, dealing with document classifications or extraction of information in documents. All of those have been amazingly helpful in many aspects of the operational part of in finance. It's sort of similar to what the banking industry has done, and they have implemented AI techniques for a much longer time than any other financial institution. Like teller machines have been used for a while. Bank check recognition and being able to deposit your checks into teller machine has also been done for a while. So I think that those things have been coming to traditional more investment bank, mostly in the operational side. Where the other aspect of alternative data to what Nico was actually pointing to is that one thing that you can clearly see in many of these models, you might not be able to use alternative data to effectively predict, for example, how much the markets will react to the coronaviruses or any event that has been totally unexpected. But what it has been able to do is to be able to allow models to react much more quickly to those events. For example, if you have a model that based on certain expectations of earnings, or for example, if you are doing merger acquisitions, right? If you have those models and you have to wait for data to be updated in those models, most likely those things don't come out in the market that quickly. So sometimes that data is stale. In many cases, these techniques have allowed you to sort of anticipate, to react to those things much quicker than waiting for 2 or 3 days for some news to happen. So in that respect, markets kind of react a little bit quicker to certain level of news because of the immediacy of data, which necessarily will be able to predict, but will adapt to that much quicker.
Nico, any technology data sets that you are very excited, other technologies or data sets you are most excited about for the coming year?
I think, well, there's two sides to it. AI more broadly, I think the discussion over the last year or two continues to shift more towards how than why. You know, I think the discussion, the general perception in the industry that I get is there's generally an acceptance now that it is a necessity for most fund managers to incorporate in some way to incorporate data and just be more data aware. And I think that's great for focusing rather on implementation instead of the theoretical discussions of should we, shouldn't we. In terms of the technology itself, I think one of the big trends that I've seen picking up momentum is explainable AI. So especially if you're a hedge fund and you're unregulated, you don't have to spend as much time thinking about how your particular tools are going to look if the regulator opens them up and asks you to explain the decisions that have been made. But the more regulated institutions, which is really what most fund managers are, that's a really big thing. And I think one of the barriers to implementing more AI is the concern that, you know, being able to explain it to the regulator is sometimes a bit of a challenge or a bit of a risk. So explainable AI and tools that make your algorithms more auditable, more transparent are starting to come to the surface. And that's pretty exciting because it not only takes the burden off the developers and the data scientists, but it also opens up a lot of new avenues. So I'm working at the moment with a startup called Retrace, who they've developed a variation or a plugin to the Python interpreter, which allows you to take any Python program you've run and open it up and track every single value and see how each model output was derived. So those kind of tools are really powerful for shifting, you know, essentially it's just for getting more buy-in from management and giving them comfort that these tools are indeed transparent and explainable.
Victor, would you? We have to wrap it up. Would you like to add anything to conclude?
Oh, we should have talked about the coronavirus too and the impact on AI. I think there was a lot of interesting discussions about that, but. Again, I think in that dimension, for example, where we have seen, as it pertains to risk management, AI has been able to introduce tools to be reactive, not proactive, and that has been very useful because it allows to streamline a lot of processes. And so I think on that dimension, even though it has to do with market data, even though it may not be totally directed to alpha generated, advances in risk management has been significant in some areas, and I think that's noticeable because risk is important, and then especially creating models, for example, for liquidity is important. It's a part of risk that it will eventually translate into income generated because it saves money, and I think in that dimension there has been some advances in AI that are definitely applicable to those. We don't have the risk management doesn't have the urgency to produce alpha in some ways, but it's important to be able to cover risk effectively. So,
yeah, well, managers tend to have humans tend to have an uncanny ability to single out opportunities, but they are quickly at odds with anyone who does not follow their line of reasoning. On the other side, machines do not care about such things; they have no hard feelings. Your partner may complain when you do not follow driving directions. If you take a wrong turn, your smartphone will just recalculate. I mean, with this, Michael.
Yes, thank you, Patrick. It's been a great convo from Clever Hans to Alt Data. We have a few questions from the audience, and we covered most of them. I'm going to choose one to finish this off, which I think is highly relevant to this community. So which models do you think are suited best to model the time varying parameters, mostly path dependent ones?
anybody?
Yeah, anybody. Whoever has the best answer.
Path dependent for what? In terms of AI or in terms of models in general?
Yeah, in terms of AI models for, I guess he's asking, it's really just what models specifically for time series problems have you found to be the most successful, I think is what he's asking.
Well, from my experience, I think I deal with a lot of time series analysis in general, and I think that of analysis in terms of time series itself, LSTMs or deep neural nets in terms of recurrent neural nets have been the most useful, and I think that that has application in certain level of time series in financial markets, not in prices per se, but in certain. The other area where that may open up is in handling interacting or highly related time series in multivariable time series. I think that's in terms of path dependent models for pricing. I don't know of any AI technique that has been effectively applied on that, but. So I don't know if that's. I will open up for the rest of the panel to talk about that.
Nico, would you?
Yeah, I agree with that. For LSTMs, long short-term memory, recurrent neural networks are still pretty much the cutting edge of time series modeling. They're very opaque though, can be quite time consuming to train. So not always the best solution. One of the things that I've also done is to try to break apart the problem, and if you're looking at heteroscedasticity or market conditions that change, using tools like clustering or random forests to determine when you are switching into a different regime and then applying a different model to that regime. For instance, high volatility and low volatility, or strong oil, weak oil can have a big impact on what kind of model applies to a company or a market. So by splitting the volatility and market conditions and then the individual models to apply in each market condition, we find that's a way of simplifying the problem, as opposed to having one master model which combines and tries to predict both of those factors.
Awesome.
I can add, for all those of you who are interested in forecasting, that you may want to have a look at the Makridakis competitions. The forecasting competitions are organized by Spyros Makridakis. The last one was held here in New York in December 2018. The results of the last one were on. And it's a competition where forecasters, time series forecasters can compare their abilities across a series of data sets covering finance, but a lot of other stuff. You'll find a lot of stuff already in Wikipedia or directly on the Makridakis webpage. One of the results of the last forecasting competition was that the best, the two winners were hybrid models, meaning they were combining both traditional statistical forecasters with neural networks, because pure neural networks machines actually did perform very poorly at this competition. And only the combination of the two proved to be really successful. The other important thing is that neural networks in those hybrid models were particularly efficient at forecasting the uncertainty of the forecast. And for all of you who are interested in that field, well, you may as well want to have a look, because you'll have directly the state of the art of, the winner was Dr. Smil from Uber Technologies. He's a really fascinating guy. And you'll see, you'll have access to his model. It's an open competition, so you have access to the algorithm, and you'll see it's really interesting.
Cool. Thanks, Patrick. Yeah, it's a good reco. All right. So to respect yours and the audience's time, I'm going to call it. Thank you, Patrick, Victor, Nico, for being here. It was an awesome convo. It really was. And we recorded this too, so we'll send that around to you guys so you can share it with friends or family or whatever. And yeah, thanks so much. I'm Michael with AI4. You can always email me at michael@ai4.io with any thoughts, questions. And yeah, thanks so much, guys, for being here. I wish you a good rest of your pandemic.
Thank you.
Thanks, Michael.
Stay safe and healthy.
Stay safe, stay sane.
Bye-bye.
Bye, everybody. Thanks for joining.